Good day. This is the Eye of the Storm podcast with the big picture technical update for the S&P 500 and the NASDAQ 100 for the futures market and the cash market. I'm going to start here with the SPX, and I'm going to start on the daily chart. The big picture really has not changed, and so I'm not going to focus as much on this much larger picture, which shows that the high remains in the SPX at 48.18, and that was achieved in January of 2022. Since that time, we completed, well, let me just state, we completed at that high in 2022 a cycle wave 5 and a super cycle wave 3. So what we are involved in now is a super cycle wave 4 correction. And I did get asked a question as how I determine that the super cycle wave 3 took 90 years. And let me just go quickly. It's going to, what we're dealing with right now is going to get all stuck up here at the top. But I've gone back. Now, and some Elliott wave analysts now are considering this, what I'm labeling as supercycle wave 1 and supercycle wave 2, as grand supercycle wave 1 and 2, which is what R.N. Elliott counted back in the 30s. But as this whole scenario has unfolded, it would have really placed the grand supercycle wave 3 possibly up here. I know there are some that are looking at this high in 2022 as the grand supercycle, and I don't. And so mainly because it's like, if we're really looking at like the supercycle degree, cycle degree, and the length of time these take to unfold, that to consider grand supercycle are multiple decades. So not just basically 9 decades for a grand supercycle, a supercycle. If we're looking at a grand supercycle, maybe we're talking, 18 or 20 decades. That's a lot of time. Now, that's a 200-year period possibly. And quite frankly, what good is that to us? And actually, we really can go on the basis, it's like, what good is a supercycle degree top to us, other than designating possibly how long it's going to take for all of the excess that's like been pumped into the market over basically the last 90 years, more succinctly, basically since 2009. So when I'm counting and I'm looking at this, I'm actually looking at it from the 2009 low, which was in the S&P 667. Now, that's quite, even off of that level, we got up to 4,818 in 13 years. That's an incredible feat. When we really, if you just take a look at it, and how was it achieved? It was achieved by adopting a zero interest rate policy, ZIRP, Z-I-R-P, zero interest rate policy. And that policy remained in effect until basically 2022. So we continued to battle with these low interest rates, and how basically the government and then the Fed continued to fund its operations and continued to fund everything at a zero interest rate. So corporations could grow exponentially because they could borrow at zero and turn around and lend it out, or turn around and use it, or get higher interest rates back. So they exploded, they grew, earnings grew, everything grew. And so what we've now gone through is just too much. So we've reached a level where many things are overvalued in relationship to interest rates today. So I think that what really we're running into as a problem is that if I'm looking at a supercycle degree third wave and it took 90 years to get here, even if we use some basic Fibonacci, how long should it take for supercycle wave 4 to unfold? I mean, I can take it back to cycle 3. Cycle 3 began accordingly in 1942 and completed in the year 2000. So even on a cycle degree, the impulse wave was a long-term move. And so, the correction, right, from that high, the cycle degree third wave to the cycle degree top of the third to the bottom of the fourth was 9 years. So if I'm looking at a supercycle degree and I'm breaking it down basically to a cycle degree, I'm going to just move very quickly down. That we're looking at here, what we're working on is a cycle degree A wave. What's going to be in the supercycle wave 4? 3 waves of cycle degree labeled ABC. And we can just walk down that ladder till we get down to the bottom to see how and what we're building on, what the current patterns will build into. So if we're on that cycle degree, we're in a cycle wave A down. It's going to consist of 3 waves labeled ABC of primary degree. So the cycle degree is kind of that brick red. The primary degree is the green. So what we have in place so far is primary wave A and primary wave B as being complete, and both of those as being a part of the cycle degree A wave. So that puts us in a primary C wave down. Those that study Elliott or have an understanding of Elliott know that all C waves will unfold in 5 waves, and they will be labeled 1, 2, 3, 4, 5. So what does that suggest? If we're in a primary C wave down, and it's going to consist of 5 waves, they're going to be of the intermediate degree because that's the next one down. So I have intermediate 1 and 2, and that basically just got switched. I upped the degree over the past week. And I explained why. And the reason is because to count them as minor degree would have placed, it kind of broke here. Again, going to come from the weekly, I'm going to go down to the daily. And again, we're just walking this down and explaining as we go along. Because what we had is if there was minor 1, minor 2, and this would have been a minute, or even if it was a minor third, minor 4 took out what exceeded the low for minor wave 1. So you bump it up. It doesn't mean that now we're going to go up because it broke that. It turns because of the larger move in force. And I discussed this, that it's like there is, when you're an Elliottician, when you're really working Elliott, you're going to start to where I'm starting at a minor degree. So it would be minor 1, minor 2, but it's actually, I have to be careful because it may be, and I talked about it, there would be a degree flip 1 higher, and it would come in once we started to further develop. If we left it in a minor, first of all, it would have invalidated itself, but say it didn't, and that was minor 3, and we had a minor 4, and now we're in a minor 5. We're just then completing intermediate wave 1, and then we still have a 2, a 3, a 4, and a 5. And again, I have laid out some parameters for that cycle A wave. So remember, biggest degree that I'm counting right now is the supercycle, but within it, the biggest degree I'm counting is the cycle wave A. And so that's going to consist of a primary ABC. If we're in that primary C wave, then to think that how hard it has to unfold, or how much room or how much space it needs to fill and decline, takes us below levels that I would not associate with an initial cycle degree A. And the reason being is that then I have a cycle B and a cycle C. And it's that cycle C wave that's going to be the most devastating part of this larger correction. And that's going to come with years. It's at least a year and a half, maybe even 2 years down the road. So what we need to finish in front of that is a cycle A wave down. And then we get the treat of a cycle B wave, because so many traders don't really understand or get too worried about trading downside markets. But the profits and the profitability and just the, just keeping it in the framework of you're just trading. There's so many opportunities. If we can divorce ourselves from the fact that it's like, well, what's going to create a serious downside market? Well, we've got plenty out there right now. And so we have this battle with interest rates. We have this battle with inflation. And then what comes after that is if we can't get a little bit of relaxation in the interest rates, we're going to run into recession. And if we run into recession, then we have a period of deflation. And if we deflate, guess what goes? If you deflate the market, if you deflate the currency, if you deflate things, the value of the equity market will sink. And then we are dealing with also, if we're just kind of talking on the fact of equities, with interest rates being now pegged 5 to 5.5. Why in God's name would anybody consider taking a long-term bond for cheaper? If interest rates are really heading 5.5 to 5.75 or 5.5 to 6, what's it going to look like as we continue to move out? And so why would an investor, or why would a large credit firm that trades the bonds, why are they going to say that we're going to load up here? If it wasn't for either a shorter term trade, but if you're really looking at, you're going to hold these things to maturity, why are you going to lock in a lower rate when rates aren't really signaling that we're done? The economy is not signaling that, like, oh yeah, we're all corrected and everything's great, and now we're going to begin the next larger cycle of economic prosperity, economic growth. We have not corrected our excess. We're started, but we've not corrected. I'm going to go back out to the monthly maximum chart. We have not started to correct our excess, which basically is really just the last 13 years in its heaviest portion. In the last 13 years, because of zero interest rate policies. Now, step outside of placing blame for that on any administration. They're all complicit. Democrat, Republican, anybody. They're all complicit in this going and continuing. And now it's been placed into the hands, because the Democrats are the majority right now in terms of the White House and the Senate. I said, well, that's their fault. No, because we can go back to when there were Republican presidents, right? This was all Republican presidents. That huge decline was a Republican president, left it to the incoming Democratic president. And the Democratic president, started it because the way out was to reboot, refund companies, refund people. This, my friends, was a Republican administration. Refund people, refund the retail space, because they're dying on the vine out there. And if they don't work, guess what? There's not any money to run the government. You can just sit there and pontificate all you want. If people can't pay their taxes, if people can't pay and they can't support corporations that buy their products, you can just pontificate all you want. Not going to happen. So in any case, what we're really working on right here is to correct the excess. Doesn't mean that we're going to crash and everything's going back to depression. In my view, folks, it does not contain that. There are going to be some strong downside moves, and we're confronting one right now. Now, besides just understanding that we need to correct this excess, and the Fed and the Treasury need to get so much off of their sheets. all of these low interest rate needs to come off. And there's not many other ways to get it off of the sheets. So what happens to all of those corporations, all of the investors, everybody who piled into treasury bonds, 30-year treasury bonds below 2%? Treasury bonds and within the last 2 weeks poked their nose on a yield basis, poked their nose above 5%. And if 5 to 5.5 becomes the norm moving forward for a while, what happens? You're going to see a lot of liquidation. You're going to have to. If we think about it, well, how does that then start chipping away at corporate earnings? We choose not to listen. Now, the big banks, they all report and they're all doing great. Well, yeah, they have trade desks that know how to trade. And trust me, they're not buying and just sitting back and waiting. They're doing everything. They're trading credit. They're trading the dollar. They're trading other currencies. They're trading everything. And they're big enough. And so they can do that and they can churn. And they trade the interest rates. That doesn't mean that they don't take hits, because if you listen to Jamie Dimon or listen to the folks at JP Morgan, when they reported, they were telling us that they have like 56 billion in loan losses, in treasury losses, because of the higher rate. And when that comes off, then they'll take it. But guess what? They're big enough and they're going to be able to handle it. As will Apple, as will Microsoft, as will all of these, the big corporations. They have enough reserves where they can. Where really it comes in as us, the retail. Do we have enough reserves to sit it out? Do we have enough reserves to kind of go through what's coming? Maybe we do, maybe we don't. I don't know. I can't speak for everybody, but there's a lot of things that we can do. There will be a lot of trading in both directions. And there will be a lot of money to be made. And all we need to do is just kind of, if you want to trade this market, folks, which is what I present each day, I really consider it's like we can't go about it thinking that we're going to be bullish or bearish. I understand a lot of what I talk about is presenting a bullish or a bearish scenario, but we just need to trade it without question. You just go in and you just trade. That's another conversation. Okay, back to the big picture. Let's back in the SPX. Enough to that. Yep, we need to correct. So the degree has got to be larger because we're correcting the last at least 13 years. So what does that suggest? We're going back to the 2009 low. Down here, all of this. So where would I expect the wave? See, now that was cycle 4, right? See, cycle 4. So what does that suggest? Elliott tells us that the fourth wave in progress will find its terminus, its endpoint, within the fourth wave of one lesser degree. Well, folks, that's the cycle degree. And that's down here. And in essence, what we're looking at is between 1590 and 667. That's where it should find. I'm talking though. I'm not talking next month. I'm not talking next year. I'm not even talking in 2025 or likely 2026. But it will come down. And now the next thing everybody wants to wrap themselves around is like, how's that going to happen? Well, could we have predicted higher interest rates? I mean, we did, but can we predict how high they're going to go? No. We have an idea. We can use Fibonacci. We can use our charts to give us a thought process in it. But I've heard people come out and talk about the 10-year note and say, well, what do you think about 13% interest on a 10-year note? Well, if I'm locked in at 5%, I'm not going to be very happy because I'll be losing so much money on my bond. that the interest is not going to make it up. So, yeah, 30-year bond, what if it goes to 15 or it goes to a little bit higher? In 1981, the 30-year bond was at 8, got up to 18%. That's pretty high. So I'm not saying that that's where it's going now. I really am not. But I'm just talking in terms of this excess needs to come off. What can create it? Well, let's talk about just for a second that, well, what do we got going on? We have interest rates at 5 to 5.5. Now, if they can cap it there, and we can get to, we finish off this cycle wave A, then we get to move into a cycle B wave counter trend rally. And that counter trend rally will also come within bond price and a counter trend decline in bond yields. That's going to be beneficiary to those that want to play from the long side. And so we all get to switch and we all get to, to buy the market, and there will be some really strong rallies, but that's not here yet. And I honestly don't think that it's going to show up until we get to a low. I'm going to go straight down to the daily till we get to a low, which of course is going to be underneath 3573 basis the XPX, which is the October 2022 low. That's the low for primary wave A. Primary wave C is certainly expected to go below that and create a new low. Where's our support then? Well, we have some support, and I'll be able to, well, I'm going to start filling that in pretty quickly here. We can put in our basic for what we think for a C wave. But here, these marks, the 2.36 and 38.2%, that is for the supercycle fourth wave. Now, I've talked about this before, so when I start to roll things out, if I'm thinking that a 38.2% retracement of that 90-year advance, you can call it a bull market, you can call it advance, whatever you want to, but that 90-year advance from 1932 to 2022, 38.2 retracement is 2980 basis the SPX, the cash market. Is that really that low? And you're at a very, very common retracement level on a Fibonacci basis. So what I'm saying is, I was like, before we go off the deep end on prices, it's truly not, when we look at the larger picture, all that much. You're looking at 38% retracement of 90 years of market activity. Not that bad if it gets there. So my initial thoughts are that we're likely going to be coming down between like 32, 3,300 and 2,980 to finish primary wave C, and in turn cycle wave A. And it's not even going to look all that bad when you consider, yep, we got a lot of territory to fill in here. And now you want to say, well, what's going to create that? Trust me, if we're going to focus on day-to-day iterations that come out of the financial media, you'll never see it. But I'm sure that there's been all kinds of talk. I don't particularly watch or listen to financial media, but I can only imagine since the war between Israel and Hamas began a week ago, well, what do we got going on? We've got international conflict, which is very likely going to spread. We also have a war in the Ukraine, which has taken a back seat, gets very little coverage. We also have a fractured House of Representatives, which you need to sit down and learn your civics here, folks, because you need to understand what does the House of Representatives do and what has been put on hold because they can't find a leader, and understand what is the job of the leader of the House, the Speaker. What is the job of the speaker? The speaker brings all bills to the floor. The speaker brings all conversation to a head and brings it to a vote. The House of Representatives is responsible for most things budget. The House's representatives is just try to learn what they are responsible to do as a functioning within our government. And then we have the Senate, who sits there idle right now, wondering, what are you guys doing? If you don't pass any bills that refund the government, come mid-November, we're going to be confronted with the same conversation we just dealt with that ousted the current speaker. We're going to do it all over again? Well, what's that going to do to the market? Because it gets to a point where it's like, okay, eventually we're going to tip over from uncertainty. What happens if the government can't pay its obligations? Oh, that's not going to happen. That's not going to happen. Really? Well, what if the inexperienced or just the radical whatever within the organization, within the House of Representatives, really just doesn't care? And they're just going to do it just to do it. What happens then? You betcha. S&P, Moody's, Fitch, the rest of them downgrade the United States of America and our ability to honor our obligations. I hear what the president says, but I got to tell you, it's like, oh, good talk. But if it came right down to it, and whether you do or whether you don't, or whether you have the power to invoke some hidden type of a thing which says, okay, we'll override them, I don't see how. But in any case, back to here, when we're trying to determine, well, what could tip over this market? That doesn't really become my focus. I have to be honest with you. There are enough things out there to do it. So I'm looking at my wave pattern. Now, the wave pattern I've just shown you has already showing that we have a strong down leg to put in the form of a primary C wave. That's what the Elliott shows me. But Elliott wave never is going to tell you this is what's going to cause it. But quite often what happens is it just goes, it just does it, and then we fill in the why after. So, and how low is it going to go? Well, I have Fibonacci to show me that and to bring that into focus for me. And again, if this, and I'm back out on my weekly, if this is going to complete possibly cycle wave A, and then I get a cycle B wave, and now I got a cycle C wave, where's that going to end up? Well, holy schmoly, if I come down here to the 50% retracement, that's 2411, and that's within this fourth wave, and it's not going to be within the larger out here. It'll only reach there. So maybe I need to revise. Maybe I need to think about, okay, well, cycle A might reach this low. And cycle B goes up, and cycle C brings us down into here. That's a possibility. What's going to cause it? I don't know. But if we don't look at what's possible because we're afraid, that's the problem. Because, fear can be replaced by being prepared, knowing what you will do, knowing what you can put into place for yourself. Okay, now I'm going to go back and let's just talk technical here. A lot of that was the fundamental. Now let's just talk technical. Technically, we're in that primary C wave down. Primary C will consist of 5 waves of intermediate degree, of which I believe 1 and 2 are complete. We're inside the third. What's inside that intermediate wave 3? 5 waves of minor degree, of which I believe 1 and 2 are complete. So you've heard me talk about this. You've heard others, if you read the comments within my daily analysis, others have talked about nesting 1, 2, 1, 2. What does that suggest? We're ready to drop heavily. We're ready to drop within that third wave. And now what it would be on a daily would be the minor 3 of the intermediate wave 3. Now, I can take this down one more and we start to look at the 4-hour chart. Now we're coming down even to a little bit shorter time frame, right? Because what we're going to work on here, we have intermediate, we have minor. What's minor 3 going to consist of? 5 waves of minute degree. Have we finished minute wave 1? I don't think so. Possibly, but I don't think so. 4-hour chart is kind of questionable. Let's take that down to the hourly and let's see. Right, the 2 comes down to here. Actually goes to here, and then we got 1, 2, 1, maybe, or we're still going to work it out. We have minute wave 1 to still finish up. So again, not clear. What does become clear is that what happens when you break the 20. This is the hourly, SPX. You break the, and I've switched over, I'm just using simple moving averages. Those are the most widely watched, and they produce the reaction that you would expect when on an hourly, a 4-hour, a daily chart, these moving averages get broken. They accelerate. Either up or down, but they accelerate. In this case, down. And then we came and we broke the 50, and we accelerated a little bit, caught the drift, came back. When we broke it here, it accelerated. And what happened to the rally? Well, the rally came, but we only got back up to the 50 period SMA. If that holds and we start to go down, the next one in line is the 100-day simple moving average, and that's at 4302. Not very far from where we closed. Now, if we come back down underneath here, then you're going to say 1, 2, 1, 2, 1, 2, and we're really going to start to drop pretty heavily, right? Minor 1, minor 2, minute 1, minute 2, minuet 1, minuet 2. That's all. Remember, Elliott building blocks, series of building blocks. What happens on the 15 turns into the 30 turns into the hourly turns into the 4-hour, et cetera, until you get yourself up to where you want to be. So it builds. So that, in my view, would be next. And it's not going to be very far. Again, you might want to say, well, what's going to cause that, Michael? Well, how about, it really escalates in Israel. How do I know what Iran's going to do? How do I know what Hezbollah is going to do? How do we know that something doesn't happen and they go to toss something out at one of the ships, the U.S. naval fleet that sits off the coast of Israel out there in the Mediterranean Sea? I don't know. What do I think could happen with Russia and Ukraine? I don't know. And I don't want to speculate. But I can see a pattern that is telling me we're about ready to drop fairly significantly. Now, what goes along with that? Well, we're now in between where we start to get our earnings reports. Now, everybody wants to hold on to the status quo, and the status quo is earnings are always good. Earnings are always good. They're going to blow the doors off. We've read all about it. We're going to have the best earnings season yet of the year. It's like, okay, all right. If we do, we're going to turn and we're going to run higher. I will tell you that. And I will go over my alternate count. I particularly don't give it a whole high probability. So coming all the way down to the 1 hour, I would look like we're getting ready to drop strongly. And if that's the case, we will come down below 42.16. Now, this is the cash market. All right, let's go over and look at the ES, which is the futures market, which is what most of us would trade. We have the same thing, except now I've kind of labeled these interiors. And now you're going to see how deep down I did go that deep. A little bit cleaner in the futures market versus the cash market, because the futures market has a whole bunch of hours it trades without the cash. Then the cash just spends a little bit of time catching up. So here we are. Go back out. Let's go back out to the daily just real quickly. So, because what else I have on here are my fibs. So my fibs go along with where our lows are. This is contract. So I could put it here to here, and it really would behoove me. And let me just go out one more. Now, see, the weekly is good. The daily, so I reflect the weekly chart for my primary C wave. And that primary C wave on my weekly chart suggests that wave C would equal wave A at 33.87. That does go down and it breaks this low, which I believe is 35.02. And it does, it does. Could that be a completion point? And yeah, it actually can. But I'm kind of looking for more. And I'll tell you why, because of my internals, where I'm thinking that these have got to come in. So let me go back down to that daily chart. On the daily chart, here we have again, ding, ding, we have that same level. But now we've got to fill in the blanks. Intermediate wave 3, those are right here. Intermediate wave 3 would be equal to 1.618 of intermediate wave 1 at 41.30. Is that a reasonable level? It is. It does make wave 3 the longest out of the 1 and the 3 thus far, but then I need to add this in. This is a clean 5 down, folks. That's minor 1. So I'm already going, okay, that may provide some support, but this is where I think we go. And we might get down that far within minor 3, right? Minor 3 should be expected to break 42.35, which is the low from the 4th of October. And that's the low for minor wave 1. Minor wave 2 should break that as it then comes in. So let's just take a look. I'm going to add one more fib in here, and that's going to be here, there, to here, to there. All right, so we have, I think this was Thursday's high at 44.30. And then we have the high for intermediate wave 2, which was at the end of August, very beginning of September. So here we have minor wave 3 would be equal to minor wave 1 at 40.67. But I'm going to be looking for a little bit more because, again, I don't want to run the risk of minor wave 3 being the shortest wave. So it's got to get past 40.67, 40.68. It's got to come in lower. And I think it will. And that's what we're confronting right now. Now, I can take it even further down. So let's just say minor wave 3 brings us down somewhere in here. We get a minor 4, minor 5, and we end up down here for intermediate wave 3. Then we get an intermediate 4, intermediate 5, and then we're looking at these levels. All right, 1, 2, 3 comes into here, or even a little bit lower, right? Intermediate wave 3, 2.618 is 38.42, 3.618, those are the numbers. If you understand fibs, those are that's the sequence. It's at 35.53. Again, what if things really start to unravel in a very, very serious way? And there's a disruption to the flow of goods and services because of a couple of wars, because of the building tension. All right? What happens to the price of oil? What happens then to our inflation? What happens all across the board? Consequence. So when you're starting to think like, what's going to bring it down here? Because we're going to have all these great earnings. That might be, but they will be overridden by the fact that the market has got to react to what's happening outside of historical earnings that are being reported for a quarter that can't be repeated. So 2.61838, 3.618, 35.53. C wave, that's there. The C wave 100%, 33.87. I'm going to show you how I can get down there and beyond. I don't think a C wave is going to get all the way down here, but it could. It definitely could. And then I go back out to the cash. And I know in the cash that I've got 30, 32, I believe, something. And that could be enough for the C wave as well. And now you're going to see intermediate wave 3 can come down to here. A 4 going to bring it up. The 5 brings us down to here, maybe. So, and then maybe even lower. Come on to that 32, down to that 29 area. Even as low as 25.85. That's the primary C wave. And if I go back out to the cash market, you're going to find another number down there. I believe it corresponds with 50%. So you're going to start to see the fibs will start to match up with possibilities. All right. Now, one thing, daily, here we sit again on our, oops, that didn't work. Let me go back, one more back out to my daily. And let's just do it this way. Do you see where we're sitting again? This is the daily 200 simple moving average at 43.25. And the low that we got to on Friday was 43.40. Not that far from 43.25. And if we have a strong enough break of 43.25, I'm pretty sure we're going to start to slide pretty quickly. We will see some acceleration because we got nothing until we get down to 42.35. So we got 90 points that we can drop. And then we're dropping into, where C wave can go. Excuse me, where wave 3 can go. And it can do it very quickly. And how does that fit into the bigger picture? Well, we talk about, they talk about stronger downside moves. Again, folks, I'm not going to use the word crash. It may feel like it. May feel like it when we're going through it. This sell-off, a lot of Friday, you're like, wow, they're just hitting bids. Boom, 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 not stopping. Hey, you guys want to pull back? No, boom, boom, gonna go. And then finally they did. Now, how do you want to trade to get along with algorithms? As best you can. Algorithms are kind of like Elliott in terms of they don't know. They're not programmed to go like, well, wait a minute, what about that interest rate calculation? What about this fear calculation? What about the war calculation? What about this calculation? Not going to happen. It has a prime directive that has been programmed in, and if it's to buy, they're buying up to that number. If it's, whatever they got to do, that's what they go out and do. And the consequence could be tick, 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 because what happens, we get into a vacuum. If you get a whole bunch of selling, and then they're done. Those same algorithms that just sold, they're done. There's nothing left to do. Here comes the buyer. The buyer's like, well, I got a whole bunch to buy. And it's like, well, guess what? You're going to push the market much harder than maybe you wanted to, because they're doing it at the market. Okay. So both directions can be in play, and I would suspect that they will be. But I think there'll be plenty to do. All right. So we talked about breaking that moving average. Again, bring it down to my hourly chart. And just got it out on a 30-day. So we'll take a look. 1, 2, 1, 2. And we're starting lower. And here we have a little bit of a head start, because here the hourly 200 simple moving average is at 43.39. The daily ain't that far away from that, right? The daily's not too far away. We're at 43.25. So it starts breaking the hourly. It might find support at the daily initially, but I would think it's going to start to break it. Okay. So that we have 1, 2, 1, 2 coming down the third, starts to accelerate, hits the other, accelerates more. We get our third in, we get our minuet wave 3, our minute wave 3, and we get a minor wave 3. So we've got, okay, let's just go from the top. Intermediate 1, 2, minor 1, 2, minute 1, 2, minuet 1, 2. So we have a 3, 4, 5 to complete 3, 4, 5 to complete 3, 4, 5 to complete 3. We're stair-stepping again. But that's the process. That's the process in an impulse wave, whether it's up or down. We have the series where we get a third wave that subdivides, which is always to be expected. Then I don't care. It could be a minor degree. The third wave will subdivide. It could be an intermediate degree. It's going to subdivide more than once off of an intermediate degree. Right? Because why? Because we have a minor degree, and then we have a minute degree, and then we have a minuet degree. That's how it subdivides. So that's bringing it down, bringing it down. Now we're in the 3 of the 3 of the 3 of the 3. So I'm expecting some acceleration here. And I got it lined up because I'm thinking they're going to come down and break their 200s. So it's kind of lining itself up to give us that extra, whoa, look what just happened. All right. Let me go over into let me start with the NDX. NASDAQ has been a very, very strange animal. Now here again, we're looking at stocks that are extremely overvalued. A lot of people want to battle on that. Just consider where interest rates are versus where the stocks are being evaluated. It just doesn't match up. And there's going to be, the war is going to happen. And what's going to happen, the war between interest rates and evaluation of where stock price should be. So again, when we're dealing with algorithms and we're dealing with day-to-day expirations in our equity markets within the component stocks, we have a weekly expiration. I tell you, all last week I talked about it in my daily Elliott Wave updates. Was like, okay, what we're working towards for is Friday's expiration, and where do they want it? I felt very strongly that they wanted Apple at 180. They wanted, Google at 135 to 140. They wanted Nvidia at 370. So what happens if they do that early? They're just monetizing that position. Whatever they wanted, they're getting out. And then it's free flow from there. And what happened? They rallied it up initially. We got those stocks up to those levels. And then somebody pulled the plug. And there was like bam, 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 all the way down, all the way down. And we see Apple closing down almost $2. We see Google closing down 1 5/8. We see Meta closing down 9.5. Microsoft 3.5, et cetera, closing down after being up. Monetize. So what happens on an expiration? They get up there, they monetize that call and or put, depending on what's going on, and they're done. They've made their expiration play. They're done. What can happen afterwards? Well, a whole bunch of gamma gets released. A whole bunch of deltas have to be adjusted. And that's what happens. And then we get the move. All right. So NDX. Let's go back out. Let me just, again, I'm not counting a super cycle wave 3. Why? Because the NASDAQ wasn't in existence in 1932. So I've lowered it for here to a supercycle wave 1. So we're in a supercycle wave 2. So again, what I can, that's the most data I can pull, and I know it was in existence before all this. So if I can get a long enough data, I can kind of pull my charts in. So basically, folks, for me, I'm basically just going as high as a cycle degree. So from here, in terms of the NASDAQ, if I'm working a cycle degree A wave down, a B and a C, well, a cycle A should probably come within, or maybe the whole thing will come within the price territory of the fourth wave of 1 lesser degree, which is the primary degree. Well, primary 4 bottomed in 2020. That's the pandemic low at 67.56. Well, even here, what a run we had. But if I have to take it back to 2009, that makes more sense to me, and I'll tell you why. This decline in the NASDAQ was cycle degree, but it was a crash. This was a crash in the NASDAQ, and it unfolded in a zigzag pattern, A, B, C, straight down. I was there. I traded this. I was on the trading floor for most of it. It wasn't pretty. The stocks got so overvalued, they had no place to go but down. The exuberance, in fact, Alan Greenspan was the chairman of the Fed. Irrational exuberance he used in speech after speech after speech. It didn't stop people, and then suddenly it just started to come down under its own weight, its own over-evaluation, its own over-expectations. This was a crash. There was the high at 48.33, 48.16. The low was at 795. 87% of its value, right? From the high to the low, 87% or approximately 87% of the value within the NASDAQ 100 cut, washed, torn away. And it only took 2 years. This was March of 2000. This was October of 2002. Less than 2 years to annihilate and destroy a lot of portfolios. So where does that leave us now? Well, we've climbed all the way back. So if I'm looking for like a super cycle wave 2, well, where should that find its lows? It's very, very difficult because I don't have enough data to pinpoint. But even if I'm looking at it to going back to the cycle degree 4, right? So let's do it one more. Let me open that up one more. Well, then it's somewhere in here. And the high was at 48.16. The low was at 795. So if I'm out all the way, excuse me, back here, and I'm looking, excuse me, and I'm looking at this low. Let me just do one more thing. Let's just take a look. Let's just kind of go from here, and I'm just going to do retracements just to see. Let's just put in retracements there to there. 48.16, 48. Now we're in the NASDAQ. Come all the way up here. I don't think that's the high, but let me go over here. 65. Yeah, it is actually 68.02, 67.64. I'm going to go over there. I'm going to correct it. So right here, we're going to go to 764. Okay, so now we're up there. So let me go back out to here. And what are we looking at? 618, 68.95. Boom. So again, here we are. We're looking at a pullback, ultimately an ABC of cycle degree that ultimately will likely bring us back into 68, top end of the 6,800s, almost 69. And we're still trading above 15,000. Okay. So what's that tell us? A little bit of overvaluation again, folks, a little bit. We never learn from our mistakes, by the way. We're doomed to repeat them over and over and over again. So here we are. Now, let me just go out to a 5-year weekly. There's the low. Now I've added this fib. That's a retracement. Clearly points to the fourth of one lesser degree. We're in that cycle degree. We're looking for cycle wave A. Can I come down to there? I'm actually thinking we're going to get here. Cycle A, then we get a B, and cycle C will be the devastation. So it's still out there. Now begin to see how I'm coming up with my levels. So again, A, B, C, NDX cash. I'm definitively looking for it to come down below this low, which is 10,440. And that was in October of 2022. That was the low of primary A. We've now put in the high of primary wave B, and we're coming off in a primary C wave. And once again, 1, 2, 1, 2. And we can go a little bit deeper, and we can go 1, 2, 1, 2, 1, 2, right? Intermediate, minor, minute. We're there. We're getting ready to drop. Now, weekly, we have moving averages. We broke the 20 and we slid through it. Moving averages we have on a weekly basis. We have the 100 and the 50 basically at the same area, 13,387. Now, we're pretty far above it right now, okay? I give that. But if it starts and it's going to break there and it's going to break below the 12,721, which is the 200, these are simple moving averages. And we have that fib level at 12,995. We got 1, 2, 3, 4 support levels that likely are going to be broken at some point. To drive this market down, we need to get below there. We got 1, 2, 3, 4, 5 to likely bring us down to here, where primary C would equal primary wave A. Then we get to have a primary B wave counter trend rally, which will be kick butt to the upside. They will floor and flourish back. Now, I'm just hoping they don't come in too early, because I can't begin to tell you, it's like there's like $5.6 trillion sitting in money market funds right now. And if they're really listening to the bigger guys and the smarter people within our market analytics, they're already saying, you want to keep it in the short-term treasuries. You want to keep it there, but just ride all this nonsense out, because the stock market's going to correct, and the bond market, they don't see interest rates really starting to drop anytime soon. So you don't want to go into long-term treasuries and get your ass kicked yet again, but you're kind of going to keep it in the short term. And at least you're going to get 5%, something, 4.5%, 5%, somewhere in there, which is better, because obviously the stock market is going to take a lot of those away. But we have $5.6 trillion that's sitting in those money markets that are waiting to come back. $5.6 trillion. I'm hoping that they're there and they're going to wait, and they're going to hold out and wait for the bottom of primary C, because that would be seed money that would just absolutely ignite an Atlas rocket, whatever the rocket of the day is. It'll ignite a rocket launch into a cycle degree B wave counter trend rally. That's kind of my own personal scenario that I play in my head. All right, so coming down here, let's bring it down to the daily. So we got 1, 2, 1, 2, and it was one hell of a second wave yet again. But it kind of got up there and it finished it up, and then we started to just hit the brakes and skid and roll. So the daily, we just basically have kind of broken back below the 50, the 100 we broke on Friday. And guess what? Right underneath it all, let me just highlight it, at 14,893. How low do we get? We got down to 14,943 thus far. It's not that much further, folks, before we're drifting below 14,900. So between 943 and then we have this at 893. 50 points. NASDAQ can do that. Oops, did you blink? Oh, you missed it. And they're down and they're breaking this. And then look, that's what I call, and you're going to hear me reference this a lot of times in my analysis, a black hole. Because we've got support, but it's price support. And we don't have anything moving average-wise, and we likely are going to fill in. So to have something for our fibs. Now, daily, let's start to fill in the fibs here on the NASDAQ on the cash market. And oops, I don't want that one. I need to have my extensions, because that's what we're putting on. We're filling in these blanks here. There, to there, to there. This is intermediate wave 3. Now we have minor wave 3. We're going to go from there to there to there. And now we have minor wave 3. So what we got going on here, minor wave 3, 13,445. Okay, 1.618 for intermediate wave 2. Excuse me, intermediate wave 3. Wow. What's that tell me about intermediate wave 3? Likely going to come down to here. So wave 3 it will be equal to 100% of wave one at 14,147. I'm going to be looking for more. I'd like to see it get close to that daily 200 simple moving average at 13,743. Give us a nice bounce because it fails to break it. Completes minor 3, goes up in a 4, comes back down in the 5, and puts it in down here somewhere. Comes down, breaks that, gets itself down here, putting the minor, and then the intermediate third wave could come in. All right, 1, 2, 3, 4, 5. And we get that, and then we get a 4 and a 5, and that's going to bring us in. Now we're still looking for intermediate third, right? We finished minor 3, 4, and a 5, intermediate 3, 4, and a 5. Now we're into here, right? And then where do we want to come down to? Likely down into here. Again, this is the larger picture. 10,663. Can primary C get down to 10,663? Sure. Ultimately, primary C would equal primary A at 96. So what, some different things, but we got some downside staring us in the face. Again, I'm not going to begin to speculate on what's going to take it there, what's going to create this, and what's going to create the atmosphere to get it there. We got plenty to choose from, and they might all gang up, right? So this is that deal. Let's go over and look at the NQ, which is the beast that I trade. And I have to tell you, there are days you're like, why are you trading this beast? The algorithms that work in this thing are incredible. And the intraday moves are like, what? And the intra-second moves, the intra-minute moves can be just horrendous. Here we are in our daily. 1, 2, 1, 2. Now, I want to go down to my 4-hour chart. And I got this going on, and I want to open this up because now I want to add, oops, you know what? Something happened. Go out here, and now I got to put my first one in, which is for my wave A cycle degree. Primary degree. I took them all off so we could see the chart. And now I'm going to put them back on. I'm going to go back down to my 4-hour chart and open this guy up. And now I'm going to put my intermediate degree. Oops, didn't like it. Get rid of it. Quickly put this into place. And now, see, I'm just kind of showing you how I do it all. And then I want to put the minor in. And we got the minor finished. Beautiful decline off that minor. Beautiful, beautiful, beautiful. Okay, so now let me pull this back. Open. I can't. I just could do it this way. Right? So we have intermediate wave 3 being 1.618 of intermediate wave 1 down to 13,498. Okay, that makes sense. We have minor wave 3 being 100% of minor wave 1 at 14,204. I'd like to come in a little bit below. See how this is starting to look more possible? If I'm thinking intermediate wave 3 will get me down to 13,500, how are we going to get there? We're trading at 15,107. Right? Okay. Well, we get a nice decline down into here. Minor 3 comes in a little bit lower. Minor 4, minor 5 takes me down to here. Intermediate wave 3, intermediate wave 4, intermediate wave 5 brings me down into my levels all the way down into here. So we got it. We can do it. In fact, we may be underestimating the power of intermediate wave 3. So it's all there. It's definitively all there. NASDAQ, oops. I hate when that one happens. Let's take a look at the hourly. The hourly, we dipped below the hourly 50, which is at 15,080, managed to bounce back up, and now we're heading back down towards it. I would imagine that this time we break it because we held it once, we broke it, took it back, came down, tested it, took it back. If we break it, we should get an acceleration, which I believe will drop us below 15,000. We start to have fib support at 15,951, 15, and then we have 618, another fib level, and that's going to be for the minor third at 14,687. In fact, I need to go out one because I need to likely take this one off because it's been penetrated already. So I'm going to do that. 618, no good. Already been taken care of, dealt with, and I wouldn't expect it to come back twice to haunt me. So we have 1, 2, 1, 2, 1, 2. We're in the third. So I'm going to put this in, and I will fill in those blanks. Minute 1, minute 2, minuet 1, minuet 2, still kind of forming maybe a little bit. And the NASDAQ probably is getting ready to kind of fall off the cliff a little bit here. I start to fill in and get itself securely below 15,000, be more comfortable about drifting down to that low, which is just the 27th of November, 27th of September at 14,586. Before I get really onto this thing for much too long, I am going to complete it right here. I'm going to thank you for your attention today, and please, questions, leave them in the comment section. I will try to get to them. Sometimes time does not permit. I likely, unless we truly gap or have something outstanding for tomorrow's Globex opening, the next update will be the Elliott Wave update on Monday, the 16th.